All right, hello and welcome to Asking for a Trend. I'm Myles Udland, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends that we'll be diving into on this Monday. Markets closing today at record highs. Will the rally last into the end of the month and the quarter? Credit scores are falling for the second year in a row, and according to FICO, they're now falling at the fastest pace since the Great Recession. Plus, the investment outlook for the fourth quarter will dive into the factors that might impact your portfolio most as we head into year end. But first, credit scores are falling at their fastest pace since the Great Recession. The average FICO score decreasing by 2 points this year to 715. Here to explain the why behind the number is Ethan Dorheim, FICO's Vice President of Scores and Predictive Analytics. So Ethan, let's just start level set with the biggest things that impact folks' credit scores and what we've seen over the last year that are weighing on what we're seeing across U.S. consumers right now.
Thanks, Myles. Yeah, by far the biggest category in the calculation of the FICO score is payment history, whether the borrower is making their payments as agreed or not. And the biggest driver, I would say, of this decrease in score that we've seen year over year is the fact that earlier this year, for the first time since the onset of the pandemic, consumers who are delinquent on their student loans are being reported as such in the credit file. So it's really the reflection of those missed payments on some 6 million consumers across the U.S. who's been a big part of driving the FICO score downward year over year.
Now, I'm curious, in the years since the pandemic, we saw a lot of consumers were flush with cash in 2020 and 21, helped push up credit scores. Just how much of a change did we see in that average cohort, and how many Americans were within each band of credit? Because you go to apply for something, it's like here's good, average, bad, et cetera. Like, what were the changes we saw across consumers? And in your mind, is this mostly like a right sizing to where we used to see folks distributed across the curve of credit scores?
Well, in net, we are actually at a better place now than we were just prior to the pandemic. The average score is over 10 points higher than it was back in early 2020. But we have seen a bit of a bifurcation of the distribution of FICO scores across the U.S. There's certainly a population who has experienced financial stress over the last few years, and that's translated to increasing number of borrowers scoring below 600. The new reporting of student loan delinquencies earlier this year, I think, increased the number of consumers in that cohort. And at the same time, we've seen more consumers than ever, well over 25% of the population scoring at that 800 or above level that constitutes super prime in the eyes of many lenders.
Yeah, and I'm curious, as lenders see that change in scores across the population, do these benchmarks start to change? Like, so far as I'm aware, it was 720 I think was considered good or maybe even great. 800's that super prime. Like, does the 800 go to 810? The more and more people that have 800, and how do how do lenders think about those changes for the whole group, given that your number is a relative number to you, but it fits within a broader distribution?
Yeah, I would say in general, the meaning of prime, super prime stays relatively stable over time. At the same time, what we often say is prudent lenders are considering more than simply the FICO score. The FICO score is a very valuable indicator of a borrower's likelihood to repay their bills, kind of all else held equal. But the prudent lenders are out there considering as well, what are the economic conditions at large? Because of course, the situation in the labor market, inflation, these are things that significantly alter a borrower's likelihood to pay above and beyond what information can be seen on an individual consumer's credit report.
So, we started by talking about how those student loan, the resumption of student loan payments has really been the biggest thing weighing on borrowers this year. What about autos and where that fits in to the picture for the stress, the relative stresses that we're seeing on credit scores? It doesn't really, you don't have to go far to find someone who can't believe how much they now are spending on their monthly auto payment. So, I'm curious how that fits in because I think you kind of go around and talk to a lot of economists, personal finance experts. It's like people will stop paying rent or their mortgage before they stop paying for their car if they really have to. So I'm curious, kind of where that fits in.
Well, that's exactly right. In fact, part of our study, our FICO Credit Insights report, which we launched last week, in which we intend to offer twice a year going forward, found that the payment hierarchy is very much the case that auto is on top for consumers. That is what they pay with priority over any of their other credit obligations. With respect to what we've seen in terms of delinquency rate in the auto space, there was a big spike in delinquencies in the auto space 2 or 3 years ago. It's actually, if anything, somewhat stabilized over the last year or so. And some of that is attributable to lenders in the auto space tightening a little bit. We're seeing the average FICO score of newly originated auto loans cresting above 720, some 10 or 15 points higher than it was just a couple of years prior. So again, borrowers are clearly prioritizing auto loans at the top of the payment hierarchy, and at the same time, lenders are being even more prudent and maybe a little bit risk averse in terms of the new auto loans that they're underwriting.
All right, leave it there. Ethan, appreciate the time.
Thank you so much, Myles.
All right, we'll have more Asking for a Trend on the other side of this break. All right, Dow, S&P 500, and NASDAQ hitting a third record close in a row on Monday. Yahoo Finance's Jared Blickery stopping by now with today's top trading day takeaways, Jared.
Thank you, Myles. We got to start with record highs. And may I say, it has been far too long since you and I stood at a telestrator. I don't know how many years this has been.
Stocks were probably records then.
Yes,
back
probably.
in 2019.
Yes. Let's just cycle through some of these record highs that we're seeing. We got the Dow, the NASDAQ Composite, the S&P 500, NASDAQ 100. You know, I was out 2 days last week and I missed the first Russell 2000 record closing high in 4 years, but that happened as well. And then we can look at some of the leaders, like we got chip stocks today. Look at what happened with NVIDIA. The SOX index at a record high. And so it's just kind of spilling over into a lot of different places. And I had a chance to sit down with the co-founder of Motley Fool, David Gardner, and we had a great conversation. He just wrote a book about breaking the rules of investing. And one of the things he likes to do is buy record highs. And here's what he had to say about buying overvalued stocks.
I love companies with great brands because brands are not anywhere on the balance sheet. So all of the greatest Starbucks, Tesla, Apple, all of the greatest brands in the world today are being called overvalued because nobody's actually putting numbers on their brand. And I would also say the same thing for great founders. Where is the number on our financial statements for the CEO? His or her value or lack thereof. There is no number. There are no numbers for the things that matter most in my world. And so I love to find the right brain qualitative things that people are not telling their computers with algorithms to chase down. And these are the things that matter most in business.
And if you want to catch 30 minutes of that wonderful hat, that episode drops tomorrow morning, Tuesday morning at 8:30 a.m. Highly suggest you take a look at that. But now we got to move on. So pesky rates. Myles, you were watching the FOMC announcement the other day on Fed Day. We saw long-term rates jump up as the Fed cut rates, and this happened last September. And we haven't seen yields really pop on the long end a lot, but let me just show you. So we were up a whopping, well, this is almost nothing. Let me just show you what's happened over the last 10 days so you can see this was Fed Day. This was last Wednesday, but it's kind of an echo of what happened, and let's put a 1 year on here, last September. This was highly unusual. I'll just circle this. You usually don't see the Fed cutting rates and see the long end pop up like that, but that's kind of the way, the environment that we're in right now. So take that with a grain of salt. The Fed is doing a lot of interesting things right now. The Fed is being shaken up, and who knows where it goes. You
know, what's interesting is what counts for volatility in the bond market different than the stock market, right? But yes. I look at the 1 year chart of the 10-year, and I say, you know, really between April and now, not a whole lot going on, especially relative to what we've seen in the stock market. And so many of our conversations on the show on Friday were in the context of like, yep, we saw Powell came out. He said, you know, Fed's going to cut rates a couple more times this year. Everyone said we already knew that. And, you know, kind of the bond market didn't do a ton, especially, you know, in terms of this, like it did not re-rate. It did not say, oh, this is a huge change to how we've been thinking about it.
To your point, the ICE BofA Move Index, which is the VIX of the bond market, this is a 1 year chart. Look, we are at 1 year lows right now. So even though we did get a little pop off that announcements, to your point, the volatility is going down. And guess what? Stocks hate bond market volatility. And so this is very supportive of stocks right now. But I will say, let's go back to the 10-year. We get a rapid rise back up to 4.5%, or if the 30-year goes all the way up to 5.1%, where it's been before, that's going to cause a problem. So we're not there yet, but just something to watch. All right. Let's move on because we got to talk about digital and physical gold, the digital gold divide.
Story of the day here.
Yes. So, what did not go up today? It was Bitcoin and the whole crypto universe. And for all the talk of the correlations of Bitcoin with equities or being an inflation hedge or all of this, none of that worked today. And so I remain skeptical that Bitcoin stays correlated with anything for a long time. I still believe in it as an asset class because the price tends to go up, but there's just a lot of variability in the movements and the correlation that just doesn't make a lot of sense to me. So Bitcoin down to 112,000, is it the end of the world? No. Let's take a look at the year-to-date chart, and we can see it's just been trading sideways for, what is that, a month and a half. And so until it breaks this range, really doesn't mean that much. Contrast that with gold futures here. Gold was up to another record high, 37.82. Now people are talking 4,000. That seems reasonable now.
Yeah, and it's, kind of go through it today. You saw, some of the quantum stocks were getting hit. Some of the meme stocks were getting hit. Meanwhile, everyone loved software. Everyone loved the Nvidia trade. Everyone loved what happened with Oracle, TikTok, its new management structure. So it feels like, software left for dead, catching a bid here. Big rotation underneath the surface, and even small caps getting a little bit of love today, though not a record high, not another record close.
Good synopsis.
Still lagging a little bit. All right, Jared Blickery, thanks so much. All right, stick around. Much more here on Asking for a Trend, still to come. All right, for investors looking for insight on what to expect in the fourth quarter of the year, Yahoo Finance spoke with HSBC Global's Willem Sells on what to consider.
Well, the title of our fourth quarter investment outlook is Riding the AI Liftoff and Seizing on these Fed rate cuts. So I think those are the two principal drivers. And that, of course, means that we continue with this bullish stance on global equity markets, on the US, and continue to invest. I do think also, the pickup in M&A, the dividend, payouts, the share buybacks, and so on are positives as well. So I think, stay in the market. That doesn't mean you don't need to diversify. Even bulls need to diversify. But I do think, when people diversify, it makes them more likely to stay in the market. So another reason to do so.
What do you think is the biggest risk going into the last part of the year?
So clearly, the economic data are going to be quite volatile. The different parts of the economy are going to, react in different ways, are going to have different timings in terms of when they see a little bit of weakness or a little bit of strength. So it's going to be quite confusing. The Fed as well, obviously, you've seen it after the meeting in what they call that dots chart. So the forecast from Fed members themselves as to where interest rates are going to end up. There is disagreement between them. So you're going to see a lot of volatility in the economic data and in the rate forecasts. But stick to the plan, keep your eyes on the price, on that AI, innovation, as well as the fact that the Fed seems to be determined to, ease policy from that restrictive level. So if you have growth that is holding up, earnings that are holding up, and the Fed cutting, it's a positive outlook.
So let's sort of dig into the playbook a little bit and some of those individual points. I know one of the things you're recommending to investors is add to quality bonds. I guess I would ask how you're screening for quality, but also, are you concerned at all about the duration and magnitude of the move in the bond market? In other words, I've talked to some investors who have said that bond yields will only move down so far if there is still something of a concern about growth, for example.
Yeah, so we are overweight on quality bonds, and quality, since you ask, is mainly investment grade. So we think that the spreads in the high yield market are quite tight. There are some opportunities in the emerging markets, especially as they are able to cut interest rates as well, in part because the Fed is cutting interest rates and also because the US dollar is somewhat weaker. So there is less risk for emerging markets that by cutting their interest rates that they weaken their own currency as the US dollar is falling itself. So that's where we are in terms of bonds. I do think in terms of duration that the 7 to the 10-year part of the curve is attractive to a very large extent because of that pickup in yield. We don't think that yields are going to drop very far. So basically what you want to do is you want to lock in an attractive level, and we think that the 7 to 10-year part of the curve curve is attractive. Lots of clients that we talk to, are finally seeing those rate cuts and finally feel that they need to do something with that cash. And bonds is a first step into the investment market.
Gotcha. Sort of transitioning out of the period that we have been in terms of the rate cycle. When you talk about capitalizing on the AI cycle here, adoption and monetization, the devil's in the details for these things. It's work to sort of buy everything, right? Everything that's related to AI, I guess. Is that going to change? And, do you share any of the concerns that are floating around out there about some of the valuations and possible bubble in some of the AI related trades?
Clearly, we get more clients' questions around that in terms of valuations. That being said, I do think this is a structural move. I wouldn't take profit too quickly on this. I think those valuations are still, inflating. And indeed, we do diversify across the ecosystem. So, that means the, automation, for example, that means security, that means infrastructure and so on. That allows you to have a broader set of opportunities, with better valuations. I would also encourage people to look beyond the US. We are seeing, the Chinese tech, picking up quite substantially. It's one of the markets that has done the best, over the last month or so. Clearly, technology that is quite impressive at much lower valuation. So by widening that scope, you can stay in the trade at somewhat better valuations. Clearly, this is also a stock picker's market. So don't just listen to me, but also at your analyst who is going to pick the right stocks. But clearly, the thematic remains in place and people should be exposed to that AI.
And then finally, you also recommend investors mitigate possible currency and portfolio risk, which you touched on a little bit talking about the dollar earlier. And you also touched on by talking about diversification, which I imagine is one of the ways that people should mitigate that risk. Well, how else should they be thinking about it?
So diversification to some people sounds unexciting and feels like, I'm going to give up on returns. You can think of it in another way. It is broadening the opportunity set. So what we're really looking for is things that we like outside of technology, but that are also going to perform in other circumstances or even address some of the risks that you're seeing. So for example, those quality bonds gives you that income, gives you the hedge against a lower growth environment, but obviously doesn't work in case of higher inflation. So where do you go when you have higher inflation? It's gold, it's infrastructure. Higher income you can get, in private credit, in infrastructure as well. Lower valuations, as I said, you can get in China, or you can get them in financials and industrials, who are two sectors that we like as well. All of those areas give you opportunities. There is no one single area that protects you against all of the risks, that gives you all of the benefits, but it's by broadening that opportunity set and by diversifying in all of them that you construct a portfolio that will be more resilient, which will keep you in the market. And I think that is really what is important, to stay in the market and to not take profit too quickly.
All right, that's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet.